All right. And we are live with Exit Liquidity. Once again, a special Friday edition. The Bulls are running through the trains in New Jersey and through the markets.
They were running. That's crazy. Stuff in New York. I used to live in New York, and everything about it just gets. It doesn't surprise me. A bull on the train tracks. What happened with Con Edison last night, and
Wait,
just
what happened with Con Edison last night?
big blackouts and stuff. And
Oh, really? Huh.
I don't know how widespread, or maybe it was rectified relatively quickly. But I'm not surprised. It's volatility, and it's risk of just population size, and it's just everything about it screams get the hell out of New York, which was my course of action, of course.
Huh.
Tapsy's in the house. Howdy.
Very nice. Well, I mean, there is much to discuss. People are filing in to the channel right now. Very nice. So,
Price action seems favorable.
price action has been, dare I say, frothy.
Yeah, I would agree.
It's it has absolutely been a very interesting few days. Everybody is all bulled up and just aping into Solana shitcoins, and it's the liquidity's back. My
Everything's at a.
my
Yes.
NFT bags are off of the floor.
Oh,
It's just, I feel like NFTs are such a good indicator of liquidity, right? Because the non-fungibleness of the tokens means that, like, it requires an active bid in the liquidity. And so if your NFTs are liquid, then everything else is fine.
absolutely. Coins are significantly more liquid, albeit there has been significant progress on automated trading of NFTs with pooling and so on and so forth. We know that over
Yeah.
the last couple of years.
Yeah, there are things that have been done to try to make the illiquid assets more liquid. Nothing new in finance to try to make illiquid assets seem liquid. You know, various means of securitizing home loans, for example.
Oh
Uh,
dear.
I mean, I know it may come as a shock to some people, but houses aren't that liquid. They're like the original NFT.
Oh, bonk on a 92% run.
I missed out on all that. I,
Wow.
you know, I did not ape as hard as I should have at the bottom. But
That's where Taiki's at right now. He's trying to align with the appropriate curve, and
yeah, it's
can't do it.
it's hard. I mean, like, you basically have to, like, be the gigabrain at the top, and then just, actually, you need to be, like, stupid as hell at the bottom, and then just slowly gigabrain up at the top, and then just get out and be like, I remember when Degen Spartan was just, like, talking about how he was like the stablecoin Spartan at the top, and I'm just like in retrospect, I was just like, man, I should have just done what he told me.
He's been through it.
I
He's been
know.
through it so many times.
It's
Yeah,
it's hard to, but it's one of those things where it's easy to be like, yeah, that's probably a good idea, but at that point you're like, I need this next 2x. 15-20% is not going to cut it. I need
a couple of multiples. I'm probably going to adopt that, and at some point will be known as Captain Stablecoin.
Yes,
We'll
and
see it. We'll smell it. We smell the exuberance, and this isn't even exuberance of what these markets are capable of.
no, I mean, honestly, it does feel a lot like December 2020, to be honest. Like it it has a very similar vibe. We had a big dump, uh, I believe in November, like around Thanksgiving in 2020. And like things kind of went sideways, and everybody's like, "Oh, is the bull market canceled? Was that the big run?" And then, it was only just just getting started.
Then 2021 hit, and that was just game on. It was
Absolutely.
January.
Absolutely, Tapsy. I was just seeing in the chat, like when it feels the most painful to be in stables is when you absolutely need to be in stables.
That's
Like,
right.
and I just I don't know that we're there. Liquidity conditions are improving. Uh, like it's been very interesting, and like honestly, let's just start. Let's pull up some charts because I think I'm gonna start with hold on, let me get it set up first.
One
Like,
maker equals one ETH. That is the maker DAO is the most right curve of it all. It's like pure
yeah,
institutional
Maker,
integration,
yeah,
buybacks.
Maker is the coin that like the TradFi boomers that like want to dabble in crypto, they're immediately drawn to it.
Is the balance sheet.
Like moths to the flame.
They actually
And
model the
so
balance sheet on positive cash flow.
so when you see Maker pumping, the TradFi money is working its way into the system.
It's remarkable. So the
But
this
right in front of us here, we have the 30-year Treasury. And holy cow, those candles. Like,
remarkable action.
like just wild. And like you're seeing like the short end of the curve is up in yields today. People are selling off the short end and they're FOMOing into the long end. Um, here's the move chart, still elevated because it's a question of it's not a vector. It's not about direction. This is a scalar. This is magnitude, and the magnitude of the moves that you've seen in treasuries the last couple days have been enormous, especially at the longer end of the curve, and like even in the middle of the curve has been just
Where are we today?
astounding moves. And
It's light today, but it was it was single digit percent moves. 1, 2, 3% moves.
yeah, I mean, the deepest, most liquid asset class in the world making 3% moves in a day. Like, you would think that that would be an abnormal situation. Let's see here. So, what is today? The 15th of December. Yeah. So, I'm just looking at the Treasury issuance schedule, and there is a big auction happening on the 21st, and then some stuff happening early in the year. Like, one of the things that some of the more cautious types at the moment I have been pointing out is that, like, after so I guess hold on. Let's start with the bull case because like let's start with the bull case because this 30-year treasury, like, this is a huge rally. Like, for those that don't know, like, when yields go down in treasuries, that means that asset has appreciated that amount. Um, and especially at the longer end of the curve, those are huge gains. Those are huge gains. So that means anyone who holds this as collateral and uses this for leverage has just gotten a huge windfall, like it'd be like the value of your house going up 20% in a,
Or
in
your
a
Ave
in
health
a
factor going
couple,
from
or your Have health factor. Exactly. Like it's it, it allows you to borrow more. It allows the um the private markets have just seen a giant windfall in their ability to lever
borrow.
up the assets they have. Now, the counterpart of this is that lower interest rates mean that parties are less and less likely to extend that leverage.
Only if
So,
there's adequate opportunity for a carry trade.
yeah. So it it is at least temporarily going to juice the markets, having had collateral go from 5% to 4%. Like that's huge. That is a 20% increase, you know,
The setup of the bull case is exactly that.
or
It's
25 actually.
the rallying of the collateral, the weakening of the dollar, which follows by Fed
Right.
funds
And
rate
and
reduction.
well, and I think the weakening of the dollar, honestly, I think those two things are related. I mean, the dollar drops because now there's more collateral out in the world that can be used to create dollars. The collateral has appreciated such that now that is viable. Um, so I think,
This this defines the destination. So the complexity is historically up until now. Um, it's the path between now and the destination. The destination is increasing liquidity conditions, collateral rallies, health factors improve, dollar rolls over, and interest rates then come down. So if the interest rates remain high, just as you say, people are restraining themselves from leveraging up their newly appreciated principal, their collateral position. But as the interest rates fall, they're like, oh shit, there's the opportunity. Here we go. And the liquidity flows, the credit extension increases. Um, so, what would distinguish this period now from times past? Times past, um, Fed funds rate getting cut is in response to something systemic occurring, significant rise in unemployment, fracture of the bond market in March of 2020, uh, bank lending completely failing in the United States in September of 2019. Could certainly go back to earlier time periods. And that's why we were talking about Stimps. Is it Stimps or
yeah,
Stimpy?
Stimpy.
That's why we were talking about him
If you don't
earlier.
follow Stimpy, I mean, if you're watching this show, you obviously have an interest in macro, and if you don't follow Stimpy on X or Twitter or the platform formerly known as Twitter, uh, then you should. He's got a very interesting perspective. Like, and from very early on, he's like, Powell's going to raise rates on you. Powell's going to raise rates on you, and he's going to crush all of you. And he was right. He was definitely right about that. Um, yeah, Captain and I were just kind of debating this earlier because we were talking about the fact that like one of Stimpy's things is that like he believes Powell wants to kill securitization. He wants to rein in the private credit markets and the non-bank lending and the asset-backed security world. He wants that to be crushed. And I don't necessarily know that I agree that he has the tenacity required and just the complete disregard for the state of markets to actually pull that off, because like some of those things, some of these asset backed securities are so entrenched, just like they were in 2008. Like if you blow up the world of non-bank lending,
People of the world.
you blew up the world. Like you simply can't without, you know, causing a depression. And I, th- I yeah, I think that's really the crux of it, is that like at the end of the day, these guys are politicians, and their threshold for pain
Pretty
is
high.
is high, but not
Depression high.
not depression high, you know?
Isn't whether Stimpy thinks Powell wants to do something, irrespective of, it's not relevant in the conversation of collateral, credit, offshore printing, and the conditions that favor just credit exploding. Your collateral rallies, interest rates roll over, dollar comes down, offshore printer goes burr.
Yeah.
What
And
what what?
it, an interesting tidbit in the news this week is that the SEC is trying to is going to be requiring hedge funds to do centralized clearing for a lot of their um, treasury trades. So like all the basis trade stuff, they want centrally cleared, which uh interestingly, the SEC commissioner that was opposed to this whole thing was Hester Pierce, who as crypto people, we tend to align with her thought processes on many of these things, because she has been a huge advocate for crypto, and staunchly opposed to a lot of the actions that the SEC has taken with regard to crypto of late. But she was basically like, this doesn't actually solve anything. All it does is just make these centralized clearinghouses more important and too big to fail. Like, I mean, it's the typical playbook. Something gets dangerous, you centralize the hell out of it, and then it's gets even more dangerous, and then eventually it blows up, and then the taxpayer's on the hook. You know,
Domestic. Domestic. What
well,
the oh,
and
what is it?
yeah,
Yeah.
and domestic. You're right. These are domestic hedge funds, and the thing is, all of this stuff, people find loopholes around all of it. It's not like it's not like these hedge funds couldn't like invest in some offshore company that then uses these treasuries, you know,
Offshore. Under different
offshore.
regulatory authorities.
Yes. Like the regulatory arbitrage here is alive and well, and they will find a way around it. You're not going to stop the private creation of money. And this is, again, this is another thing that I think I disagree with Stimpy's on it, because like he's very in favor of this centralized clearing model, and I just don't see it as being a meaningful way to fix anything.
But it gives them control. Then they have
It
a
it gives
capacity to
them the
pull the levers
illusion. It gives them the illusion of control.
because it's a global world where they've printed the entire money supply of the world outside of the US, and M0 is basically 0% of global money supply, and M2 is a fraction. US M2
Yep.
is what, like 10, 12%? Mike Howell talks in terms of $270 trillion of global liquidity, and M2 is not even 20 right
Yes,
about now.
20.7.
Yeah, so literally it's less than 10% of global money supply, the real money that actually makes the world settle internationally and transact. And what is money? Money is incentive. So that money, that 270 trillion, is what makes the world work.
Yep. Yep. Um, Another thing news-wise that's happened over the last day or two is China, the Bank of China is putting out like, I think it was like 120 million dollars or $1 billion worth of stimulus, which 120 billion, that's on the order of like BTFP. That's It's not nothing, but it's also not like, you know, releasing the floodgates. But I think we sort of talked about this last week, but like I think the Bank of China, they've been very hesitant to deal with the deflationary things that are going on over in China because we talked
Literally
about the fact
negative.
that like at the end of the day somebody needs to take the L, and I think that they're just in this sort of like creeping realization that it's going to be the Bank of China. And it's going to happen at the expense of their currency. Like, I think that's really where things are headed as far as that's concerned, but it's going to be a slow process. It's not going to happen overnight. Um, but but again, this is just more liquidity into the system. 120 billion here, 120 billion there. Like, starts to add up.
It all ends, as Brent so well sees and has seen for a long time. If the L in China is at the currency, that's the same L that everyone takes. They always defend the bond market because the bond market, which is what finances literally fiscal spending in every country. So
Mhm.
if the currency is the inevitable destination for the loss, there goes the dollar to 500, 1,000. But
Well,
it doesn't mean what everyone thinks it does. It's all relative. The world is a relative situation.
yep. So here's let's see, let me put this into candle mode. I don't know why it does this where it like switches and then force like there's some charts that I want in line and some I want in candle, and it always like if you use line for anything it tries to use it for everything. Um okay. So yeah, you can see that there's been some action here as far as getting the currency off the high peg here in China. We shall see how long that actually lasts because you know, you can't defend it forever. Here's the Hong Kong dollar, which I mean to me at this point, given the way control of Hong Kong has been handed over to China, these are just basically two different currencies with the same controllers at play. So, but this right here should speak to like dollar conditionings loosening. Like you will see it express itself very early in the Hong Kong dollar and some of these like managed currencies that are managed within a window. If they're right up against the top of the window, DXY is going to be going up because it is indicative of tight dollar conditions. Whereas, when you start seeing those currencies come off of the top of that window, uh, so this is like the top and this is the bottom. If you see things down here, that's just massive central bank action right there.
It's
Means
tight Hong Kong dollar conditions.
yeah, and then or yeah, but like US dollar domestic, like,
Excess
you know,
supply.
excess supply, like that is exactly, oh, look at all this QE here. And then up, 2018, 2019, up. This is when repo blew up. All right, that's the QE printer starting. Okay. Boom. Like you can see it all on these charts, like as to what monetary conditions are doing. And so you know, I think these are telling you that dollar liquidity is good. That that
Improving.
spe- that speaks to me that we are in a risk on place right now. You
We're
know,
post bottom, surely, as Raul would say, it's post bottom about a year. But
yeah,
look at the time frames. That's why I love high time frame charts. And what they're looking for, or what we should be looking for as we look at markets for investment opportunities, is cyclicality and the time period of the cyclicality. So once the dollar starts weakening, it's going to continue weakening structurally because that means other currencies are strengthening, which means opportunities in those countries are strengthening, which means capital will flow to the opportunity, investment in those countries. And that is a cyclical process. Directionality persists until capitulation. So, what does that mean from a cycle perspective? That means when we're looking for investments, this directionality will continue for a period of time until capitulation. And that's exactly what we've seen play out as we discuss Bitcoin halvings, as we discuss US debt refinancing cyclicality. So we have a couple more years of this directionality to play out before things stop and reverse yet again.
Yup. And here is our favorite stablecoin chart. This is the embodiment of the euro dollar
In crypto markets.
in crypto markets, which, are becoming very, very relevant. But look at that, 116 billion. That's one China stimulus package right there.
We look
Um,
at pretty much. If we look at DeFi Llama, we're at 129 with endogenous dollar liabilities included. So it's small. And
yep.
that's interesting because small can become smaller, but small equally has the potential to become not small. And that's where the
Indeed.
opportunity is.
Here's my ETH chart of where our conditions are, whether they are, you know,
Frothy or not.
oversold or how frothy we are. And honestly, not too frothy. Not too frothy yet. Haven't even hit the orange yet.
Literally, Stimpy argues exactly what we're looking for from a liquidity perspective. We're looking for stabilization and suppression of volatility. We're looking for not a return to ZERP. ZERP implies, or a significant emergency reduction in rates implies significant liquidity issues and volatility issues and crisis.
I I honestly think that I don't know where you're at on this. I guess we'll feel it out. But like I think that the reason that ZERP didn't work and why you saw global growth just roll over during this time period is that when interest rates are this low, when the collateral has nowhere to go but down, there is zero incentive to create dollars in a non-bank capacity. And so you saw that malaise that just happened over the formative years of my millennial upbringing, where it just there was nothing going on economically really because interest rates were so low that private dollar creation was not incentivized. And so that's why the Fed was struggling with
Voting.
controlling inflation to the downside. They were literally talking about how low inflation is a problem because they didn't know how to actually spark inflation because they thought that lowering interest rates would support and you know be looser monetary conditions. But what they fail to recognize is that this is what loosens monetary conditions in the private realm is having high interest rates that create a large delta by which the lenders in the private markets can capture a large spread. They have they've been able to buy collateral at a low price and they take less risk if it is more likely to appreciate versus depreciate. And so it's game on for lending in the private eurodollar markets. And
The key,
so that is why, in my opinion, we had this malaise that lasted from like the great financial crisis to basically 2020. then we, bulled everybody up with fiscal spending. Then that got out of hand and we started to see actual inflation. And then we started to raise rates. And raising the rates, if you raise them too high, I think it could honestly have the exact same effect and create inflation going the other way, where the private money is going gangbusters and the public money is drying up. So it really, again, it's about this balance between private and public money, you
I
know?
think that's well said. Clearly, with rates at zero, the real economy is expanding in a very malinvestment kind of way. It's just free cash, as many would argue, and it freezes the financial economy.
I think the other thing that the low interest rates do is, because financial institutions have little incentive to extend credit with low interest rates, it also creates this sort of environment where you are likely to get um, unequal distribution of credit. And all the ex Goldman types that have the connections required to actually get a multi-million dollar loan, they start being able to have huge benefits from sitting, all those Cantillon effects of them sitting next to the money printer start to create huge amounts of inequality over time. And whereas when you have private money creation, it much it much more distributes that inequality out throughout the rest of the economy, because it is happening so many more places, and it is able to happen more freely wherever credit extension is economically viable.
D- Managing the distribution of capital, we're resolving disparity is an entire separate conversation that is incredibly sophisticated. That you need teams for that shit. Because obviously there's plenty of ways financial economy expansion can benefit more and more people, but clearly we're not trending in that direction. For instance, private money, a bull market and private credit, and the average stock market going up significantly. And if the general population, 50% of the general population has significant exposure to the stock market, then everyone's getting more wealthy. And then you have consumer price inflation. That's another story. But it's all the knock on effects. And what do we see in the data? The data is that the vast majority of the general public have zero exposure to anything other than dollars in a bank account, bank liabilities.
Yeah.
So we're not in a good position at all with regard to disparity. In fact, the most interesting observation I have, share your thought. I want to talk about where we're going with interest rates. It's interesting.
Oh,
Where-
you
where-
wanted me to comment on that? I thought you were about to say something else. Okay, so as far as where we're going with interest rates, I think, just so first of all, like, the Fed just had their announcement or whatever. Was it yesterday? I don't know. The days are all blurring together. But
2 days.
everybody saw it as unanimously bullish, like that they were basically like super dovish, and that they were going to be like loosening. And then uh Fed Chair Williams came on. I think it was, I don't remember what talking head show he was on, but like was basically kind of walking back the market's reaction yesterday, being like, it's dovish, but not that dovish. Like, you guys need to cool your jets, because and this is what the Fed always do. They just try to jawbone the market into
Pretty much.
being what they think is reasonable. And I think that the market sensed that they were like, okay, yep, we're done hiking, and we're thinking about cutting. And the market saw through all of it. And that means bid long at long duration, because and honestly, the Fed does not have a strong history of, you know, showing the market who's boss. Like, if this is what the market is thinking they're going to do, that's what they're gonna do. Um, Now they're they're not going to they might walk it back somewhat and try to like mute some of the you know, directionality of it to try to like make it so that it's not quite so decisive of a move. Uh, but the fact of the matter is that the market tells the Fed what to do. And right now it's telling them, yeah, you're going to lower rates. Like they're calling the bluff. And
It's not why it's not Gen Pop gets excited with the rate cut, but it's the mechanics that are wrongly interpreted. The rate cuts over the next year are going to have a marginal impact on the real economy, which unfortunately I'd say is consistent with increasing disparity as time goes forward, because the second they start cutting rates, there goes the incentive for private credit, and collateral just rallied. If you go back to the Fed funds rate for a second,
hold on, Fed funds.
so by definition, we are about to have a market in risk assets that's not like 2020. It's going to be 16, 17, or rather, it's not 16, 17 where you're coming off zero interest rate. It's going to be a market that we haven't seen in a long time, and history doesn't repeat; it rhymes. Why do I say this? Because a move from 5% to, let's say, 3.5% is going to be a flood of private credit market liquidity, not the real economy. The real economy is going to continue to sputter along like an engine that the idle finally started to stabilize a little bit. It's not any activity in risk assets is not going to be driven by real economic activity. That takes a half a decade or a decade to pick up. It's slow as shit. But financial market activity inflates instantly. If all of a sudden a bank in Europe is dealing with 3.5% rates as compared to 5, that changes the entire underwriting process overnight,
Yeah.
and all of a sudden there's a completely different credit market.
Yeah, and this is what happened too, like with all the like consternation over the dot plots, you know, in the fallout of SVB, that you know you guys said you weren't going to raise rates, and then you hiked them to the moon, and it's like the 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 way that these tools are wielded is just so full of hubris that
Yeah.
they understand the impacts of uh what they're doing and what these second order effects are. Like, I mean, to your point, like, you know, here's some notable times when we were paused and about to cut, like April 2007, uh May 2019, um you know, July 2000. This all sounds very ominous, to be honest. Like these are
Yeah.
the last few times that we got to a place where we had raised rates and then said, okay, I think we're going to stop here. This seems, you know, I mean, that should tell you how successful we are at these hiking cycles, and just how long and lagged the effects of these things are. So like, sure, I mean the party's still going. The party's still going. And it will for a while. But I do think that this reversal and the expectations associated with it start playing out earlier than people want to believe. Um like let's just go back to that time. Like, so January of 2000 was about when the 30-year Treasury peaked, right? And in yields, and then the bond market saw, oh man, I think I know what's coming. And then so let's go back to that Fed funds rate chart. Let's see. Boop. All right. So, you know, here's so the
Bonds rallied
market,
as
yeah, the bonds rallied like when they were still hiking. And because again, the bond market knows far ahead of time what the Fed is going to do. It's just a matter of time. And it takes the bureaucrats a while for their lagging indicators to catch up. But like they hiked for a little while longer. And then a year later, they were cutting like crazy. And it was not at all bullish when that happened. So, like, I don't think people should be, because I do think that the act of cutting, it does change the dynamics, especially when you're moving interest rates that quickly. It does, like anyone who's doing lending professionally, like that is a very hard situation to deal with when you're trying to manage risk and you got some 4-year-old at the Fed just like playing with all the knobs. Like it's,
the knobs. Yeah,
you know,
it's a
like
mental model.
it's, but it's just like it's you're as like a risk manager, you're probably going to go, let's hold off on loans for a little bit, wait till these things die down a little bit. Okay, all right, I think they're not going any lower. I think we can start doing some stuff again. Like, but like I need that 4-year-old to cool it with the freaking knob. uh
So the question that is probably most meaningful, how does coming events compare potentially to previous events? And my expectation is not the same kind of volatility that we had when they were previously cutting. I think their intention, so this is like what Stimpy would train of thought. What is their intention? Their intention is peak Keynesianism. They want stability. They want to be able to cut the rates. The real economy starts to pick up. The financial economy starts to grow. Assets start to get bid because of increased liquidity in the financial economy. So the question becomes, are we at peak Keynesianism where they actually have control to a degree over
I do,
stability?
I don't think that they will ever have control. I think they're always one step behind the actual economic activity, and they're they're regulators. That's what they do. They wait for something to break and then they step in 2 years later, 3 years later, after they've managed to run it through committees and come up with some solution to fix it next time. But nothing actually ever gets solved. All you're doing is just moving the problem around, because risk is not created or destroyed. It is just moved. And like you're not fixing anything by centrally clearing your treasury market. All you're doing is you're taking the counterparty risk, you're moving it from one place to a central place, and you're going, all right, now all the counterparty risk is in one place. Uh, I guess we can't let anything happen to that one place. And meanwhile, you're also creating all sorts of moral hazard where now the people don't have to care about their counterparties, because who cares? I'll deal with whoever shady person wants to offer me the best deal on the street. Like it doesn't matter, because look, the Fed's gonna take the fall if this thing blows up. Like I don't think that fixes anything, but the bureaucrats like it because it has that illusion of control. We're centrally clearing it. Now we get to decide who gets to play and who doesn't get to play. And it doesn't make anything actually safer though, because like the they're only in charge of the hedge funds and the financial players that are within the scope of their regulatory authority, and regulatory arbitrage will
They're gone.
continue to
Yeah,
ensure. And the more you clamp down on this area here, the
goes there.
more the problem goes over here. And then 3 years later, after something blows up, you're talking about how to fix this thing and to bring more of this thing back here. But like, there is an illusion of control. You think you can control this stuff, but you can't. Like, all this regulation is just completely fruitless, because there will always be someone willing to offer a completely deregulated experience elsewhere in the world, and they will outcompete everyone offering the regulatory route. And it's going to just, the tighter you clamp down over here, the more it grows over there.
I'm curious how, I think often how it breaks. And that's what I'm trying to wrap my head around. And the intention of the Fed is certainly not to return to zero, because it's the real economy that's is most important on their mind because of political optics. So if they can't go back to zero and they want to control consumer price inflation, they need to restrain credit in the real economy, um, and move the risk over to the financial economy. And this is what every damn country that goes parabolic ends up with. And you could talk about the debt construct, a little bit independent, but look at the stock markets in all the hyperinflated countries. That's all the financial economy. So all of that volatility, all that credit expansion is occurring in the financial economy, and the general public credit condition is relatively tight. Otherwise, there'll be financial opportunity and business creation, so on and so forth. So this is the destination, which unfortunately is very consistent with significantly increasing disparity. They can't go back to zero, political optics, which means everything that we've talked about. The next rally could potentially be absolutely monumental, because all that uh, risk they want it to be shifted to the financial economy.
Yeah. Yeah. And honestly, like, I think if you start seeing the like fiscal situation get worse, like, well, and here's another thing that like Luke Groman always talks about is the fact that the US government has become so dependent on financial uh gains, like capital gains and stuff, to actually fund the government, that it's they need paper gains and they need all this stuff to pump in order to actually run the government anymore, because it's so little of it is coming from corporate taxes and income taxes. Like, they need, in order to balance their budget or even have a shot at balancing the budget, they need everybody to just FOMO into dog coins and like,
And have non-optimal tax structures.
and have non-optimal tax structures. And so like, there's kind of a perverse incentive for the bureaucrats to pump my bags, because then I have to pay outrageous tax bills. Um, and so I think that you're going to see, I honestly think that like going into this next year, I think you're going to see everything just kind of pump at least through the end of the year, because that will kind of take some of the pressure off the Treasury, who's been, hurting uh, with the way these Treasury auctions have been going.
Where are they going to get the capital from? They're not going to get it from the real economy. It's not all of a sudden Ford's going to quadruple their the amount of taxes they owe.
No. It's all just manipulating. It's all just pumping bags. But and that's where a lot of the you know inequality stuff happens, right? Because like these, Fortune 500 companies that all have stock, like the entire purpose, like the entire government is subservient to the price action on these 500, you know, companies that are pushing out securities that they then, uh, you know, create revenue streams for the government, which they desperately need now as they're running, 8, 9, 10% of GDP deficits. Like,
Oh my God, that's insane. A tipping point in all regards, which creates conditions that warrant analysis suggesting how is it different? It is different. And how is what's where the opportunity will show itself. It's not different with regard to volatility. There will be volatility, but their entire mandate is to suppress volatility such that there's an actual financial system that continues to operate so they could finance fiscal tax receipt requirements.
yep. And, you know, I think you can always see it on these charts too. Look at this. Like,
Share it.
we do. Oh, sorry, my bad. Let's see. So here's the Fed funds rate, right? Like, they always think like, oh yeah, well, we're never going back to ZERP. Like, like, we're not going to go back to getting rates that low. They raise them, raise them, raise them, and then they lower them, and then they're like, yeah, maybe we're gonna just stop here, and then they're like, no, we got to keep going, and then they drop them some more, just like with the raises. And same thing here. It's like, dude, up, fell off a cliff. All right, we can stop here at 1.5. That's nice and low, right? Nope, boom. You know, like, so the other thing I think that remains to be seen is that when things start getting bad, is the Fed actually going to stop when they get to 3, 2.5, 3.5, somewhere in this vicinity? Yeah, they might try. They might try. But the thing is, will they stick the landing? I don't know.
What if the argument becomes the decreasing of interest rates is not capable of producing the effect they need, especially in the time frame that they need?
Well, and then you get QE, and then you get more balance sheet expansion. I mean, that is that is what happens. Um, so it's I mean, that was the whole reason that QE began, was because they were on the floor, and you can't lower interest rates negative without having other completely messed up knock-on effects. And so the Fed has historically been unwilling to even consider that, because it does create some very perverse incentives having negative interest rates. You get people hoarding cash in vaults and stuff like that, and it becomes like, literally, like, hedge funds start just hoarding cash in order to sell a product that allows, you know people to have 0% rather than negative, what, 75 basis points or whatever.
So if the
And
Fed doesn't want a QE, Stimpy talks about, I love how far he goes into that perspective. So if that's their intent, I'm still very curious about what Treasury has in mind, because they could pull some very interesting levers that are not possible at the Fed level. And also the levers that Treasury has access to and can create is nothing we've ever seen before with effects on the markets. At least not in our lifetime. We haven't seen that kind of activity.
yeah, I mean that, and I mean the Treasury spending down the TGA lately. So
And think about it
TG,
like this. Think about it like this. So the Fed puts a bid on the long end on duration. How does the market interpret the Fed's bid on duration versus the Treasury's bid on duration? Can it be the case that Treasury's like more potent? It's like, oh shit, the Treasury is going to bid this. Okay, so the Fed's not going to intervene and add to their balance sheet. And the Treasury is, markets love to test. So then the market uh, wants to see what the Treasury is capable of if they push it to the threshold. And I think the Treasury is has unlimited capacity, even more unlimited capacity than anything the Fed could conceive of.
Well, especially right now, right? Because right now the Treasury is in the driver's seat. The Fed, because of QT, they don't really have a lot of control over what goes on in the Treasury market right now, because all they can do is kind of choose, like, because they're rolling off the balance sheet that they have, right? Like the treasuries are maturing. As that stuff matures, they choose a certain amount. I think it's like 70 billion a month or 60 billion a month, something like that, that they're rolling off. And they're basically saying, okay, that 60 billion, we're just gonna, buy back and burn our dollar tokens that we've created. Uh, and the rest of it they're using to buy, you know, issuance to replace that. But they're like they're not really appreciably changing the duration of their balance sheet, right? And so there's not a lot that the Fed can do, you know, currently, or at least they currently are not doing, to support the treasury market. Now, the treasury, on the other hand, what they can do is they can decide which tenors get issued. Do you issue a bunch of 3 month? Do you issue a bunch of 2 year? Do you issue a bunch of 30 year? And what they have been doing of late is issuing a lot of bills. Now, there are different ways of interpreting that. Either they're doing it because those assets are more cash like, which means improving liquidity, which means going into this here end of year, they're going to juice the markets. There's an election next year, you know, good for all those things. Get the stock market pumping. That's fine. All well, tight monetary policy is taking place. Um, so that's one way of doing it, because historically 15 to 20% is the bills to is like the share of bills to the broader treasury issuance. But they've been running at 22, looking at like 23. And so, they're clearly aiming a little high on that stuff. Now, the other thing that could be happening is the Treasury is going, hey, why would I lock in a 30-year or a bunch of 30-year treasuries right now when we're going to lower rates in a few months? Like, I should just issue a few of these, a few trillion of these bills, and then what I'll do is it'll only be 5% for a few months. And then, we'll get to refinance all of that debt at 3% or 3.5% or 2%. And you can go further out the curve. And so maybe there's some of that going on. It's hard to be sure. I'm not in Janet Yellen's head. But the other thing to keep in mind too about that is uh the idea that, like, if the treasury is making a good trade as far as that's concerned, they're doing it at the expense of the private markets. They're issuing more of these bills uh, that are not going to appreciate the same way when they drop rates as the long duration will. And to the same thing, like, Druckenmiller was going off on Janet Yellen for having not issued a bunch of 30-year treasuries at the bottom of the market. But the thing about that is the Fed is, or the Treasury is, generally not in the business of market timing. And here's the reason: because if Janet had just gone, ha, 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 I'm going to issue so many 30-year treasuries, like, all those treasuries would have gone out into the broader world. They would have worked their way into the financial institutions. And then when they did raise rates to 5.5%, it would have absolutely wrecked every single one of those private investors.
Horrible.
And
Yep.
and that's not good either. And so, like, I don't know that I really buy the whole, like, that second story where it's like she's just sort of timing the market because she knows that the but at the same time, like, the heat is on for the Treasury, at least it has been the last few months as far as, like, man, you got a lot of debt you need to issue. How are you gonna get that done? The Treasury market's, not terribly liquid.
Fortunately, it's testable. The second story. We'll see if she issues a massive amount of debt at a lower interest rate. What's the setup looking like for 2024? And where do we think interest rates are heading over the next decade? 2024, dot plot says reduced interest rates. Market says reduced interest rates. Uh, Tax receipts say, yeah, they're going to have to reduce interest rates. She has a second chance at issuing trillions. How many trillions? At 3.5%, 30-year, lock it in with rate expectations going to 4, 5, 6, 7, 8. The directionality shift. And how much do they have to reissue next year? $10.8 trillion of refinancing plus fiscal deficit.
That is a lot. That is a lot. I think that if, you know, let's just say that this bull market is sort of confined to, you know, now through the first half of next year, right? Like, the deficit is going to have a hard time the following year, like, you need those profits. You need all those profits to keep this
From the deficit
deficit run.
exploding.
Yeah. And it's going to be interesting to see how they go about doing that.
That's Luke's argument. The only way you cure the deficit is significantly inflate the money supply, which has the knock-on effect of consumer price inflation. And now you get your debt to GDP down significantly.
Yeah. Yeah. I mean, especially with the backdrop of a declining population,
Oh dear
which
God, demographics.
yeah,
You brought in the demographics.
I
Oh,
know. I mean, but, like, honestly, demographics, I think interest rates are a function of demographics.
did you
Um,
see that there was, for the first time in forever, good old Disney reference, there was 0% population growth last year?
I did. I did 0%. Like, it's
Crazy.
yeah, it is crazy. And if that starts going negative, like, it's going to bring into question every social program that has ever been created,
No
because
structure.
the structure just doesn't work when the population's not growing, so that you have more and more people taking care of fewer and fewer people. You have fewer and fewer people taking care of more and more people, and that just doesn't work.
You
It's
can't do
not.
social programs in those conditions.
No, you can't. It's just not going to function. Um, like, I, am not opposed to social programs, like, in nature, but, like, the demographics
Mathematics.
are just going to make it a completely not viable way of proceeding. I mean, Social Security is going to be screwed.
That's
Like,
the whole projections. The CBO projections for Social Security. It's done in 32.
yeah. And honestly, I think that the reason the demographics are the way they are is because of the inequality. It's one of these things where it's like you have hogged so much of the pie that there isn't enough to eat for the rest of society, so it just gets smaller. And now you have a smaller pie. And
Yeah, conditions favorable That's an interesting conversation. We don't have to digress too much, but it's interesting to think about conditions favorable for the increasing of the bottom of the demographics column. It's because the wealth isn't that ironic? The wealthier you are, the fewer children you have, because the whole calculation of how much you need to optimally rear your children. So
Yeah.
that's a complicated one. That I'll leave that for Peter.
Yeah, Peter Peter always talks about how, like, when you're on a farm, that's free labor. That's free labor that you're making when you have kids. And, my mom grew up on a farm, so, like, I'm familiar with that. Um, and, it's but in a modern world where if you live in a city or something like that, like, kids are just a liability. They're
Yep.
expensive. Daycares are absurd. Uh
The numbers don't crunch, just like they don't crunch for Social Security anymore. Just like what the hell are they gonna? Literally, it's the fiscal structure warrants they have to do something not in the future, but the immediate future, as in 2024. If they literally continued exactly what they're doing this year, considering the refinancing requirements and deficit next year, I can't even imagine what the hell happens in 2025. So whatever, they're going to be pulling some serious strings literally just next year.
Yeah. And I honestly think but like underlying, like, I feel like that whole reality sort of underlies the entire reason for why they hiked rates as quickly as they did. They wanted to get it over with so they could get back to funding the deficit.
That was the
With low,
restructuring. That
yeah.
was the start. So they must have, I think in terms of like planning when I'm at the office and I'm working on a project, breaking down stories and projecting timetables. So when they decided to start the rate hike cycle, they must have had this longer time frame perspective in mind, and that I would be interesting to be a fly on the wall during those sprint planning sessions of of yeah, we got pretty much the next 1 or 2 years in mind. Like, what are we going to start doing in 25, 6, 7, 8? And they'll get to it. But it must have started when they started to hike rates. Like
Yeah. I
there's
mean,
a has to be some sort of sophisticated plan because there's some serious shit that's going to go down in 24.
the demographic differences between when we were up here
Hmm.
in the 1970s, 80s and where we are now are dramatically different. Like, population, this was peak baby booming era right here.
Yeah.
Like, and it's been down only since then. So we will see. Um, we will see just what interest rates are going to do long term. I don't know. I don't know.
It'll be an interesting year, but I think it's going to be relatively not frothy, but buoyed, supported markets. They don't want the market suppressing a volatility mentality. They don't want the markets to collapse. They don't want the markets to go vertical. What they want to do is suppress volatility so the system functions, and they want to skew it to the upside so the system functions favorably such that they have increasing revenue streams. Just simple balance sheet mathematics.
Yep.
So that's our directionality. As long as this system works and does, we don't have a fracture, the directionality going forward is minimum volatility and skewed to the upside. And that means crypto assets outperform NASDAQ, outperform the S&P, and that's the general expectation. So the question is, do we experience some sort of structural event like 2020, which requires significant intervention and course correction to get back to that low volatility, skewed upward environment?
This is the question. And if so,
Destination versus
yeah, and when will we get there?
24.
Yeah, at
It's
some point in
has
24, I think it's fairly safe to say that we are and have been in a very unsustainable place. Asset prices high and interest rates high. Um, I think is sort of, especially like housing and stuff like that. Like you've seen, like house prices cannot stay elevated at 8% mortgage rates. They just can't. The math doesn't work out when 80% of people can't afford a median house. Like it doesn't work, especially with the other demographic stuff, which again is if nobody can afford a house, nobody's going to have a bunch of kids, like
my man Ben. That's the frozen real estate and real economy credit markets. Complicated. Let's continue our
yes, we will.
macro journey.
Yeah, we will
Igor,
discuss more.
Igor had a question. I'll handle that
All right.
on the captain's channel. That's a very crypto centric topic. Lots of opinion, but for macro land out there, just it's gonna be intentionally a suppressed volatility environment skewed upward. If something breaks, it does, but they'll have to course correct to get back to that skewed upward for their fiscal situation and tax receipt requirements. So that's the whole path destination. The destination is clear with regard to the topic of liquidity condition. The path there, ever uncertain, as always.
And that's why we will be back next week with more musings about where we are and where we're going. So
Amen.
until then, don't be exit liquidity.
All right, boys and girls, be well, be smart, be rational.